Welcome to Manage Your Damn Money with Ben and Malcolm, where we trade in personal finance advice for entertaining conversations about money, millennials, and the young at heart. Welcome, world, to yet another episode of my favorite show about money, Manage Your Damn Money with Ben and Malcolm. Malcolm Ethridge, licensed financial advisor and CFP. How are you doing today, sir?
I'm good, man. I'm good. I'm glad to be back. Folks may notice that we had a short little break in production. I got a couple of messages, believe it or not, about that because it's conference season and I was traveling, so that one was completely on me. But folks are noticing when we disappear for more than a week, which I find exciting.
That's always special, man. And we actually have some interesting news about our episode frequency. Since you bring it up, we are at and about, as of to the recording of this show,
right,
we have 91 episodes of Manage Your Damn Money available for people to listen to.
That's a lot of content.
It's a ton of content. I'm looking at other people who have who I wouldn't necessarily compare ourselves to, but who have about the same. There are other shows that are in our realm in terms of subject matter, and one of which I'm thinking, which I'm not gonna, we went on the show, Motley Fool.
Oh, okay.
They have 120 plus. We're right there.
And they have an in-house studio.
They have a whole everything. So anyway, so we're doing pretty good. And if people get into this show for the first time, there's plenty for them to listen to.
And it gets progressively better.
Indeed it does.
So if you start from 1 and make your way to 91,
Absolutely.
It gets progressively better, in my opinion.
Absolutely. Well, on this episode of Manage Your Damn Money, the conversation at hand is the WeWork IPO drama and the mythology of unicorn startups, Malcolm. A very interesting ongoing conversation that you and I have been having personally. But before we talk about that, as we do on every show, it is now time for headlines. E-Trade joins rivals by ending commissions in a race to the bottom. This was an October 2019 piece on Bloomberg by Annie Massa. E-Trade Financial Corp cut trading commissions to 0, joining major rivals in the race to the bottom and setting the stage for mergers among discount brokerages. The end to commissions on U.S. listed stocks, ETFs, and options trades go into effect October 7th for the New York-based E-Trade, said in a release on Wednesday. Its options contracts charges will be cut to 65 cents per contract for all traders. E-Trade estimates a loss of approximately, get this, Malcolm, $300 million per year in revenue from the drop in commissions. The move
huge.
That's what?
That's huge.
Okay, very good. And the move shows the intensifying competition to lure retail investors who gravitate toward the cheapest offerings. Interactive Brokers Group Inc. in late September announced commission-free trading of U.S. listed stocks and exchange-traded funds on its platform. Charles Schwab Corp. And TD Ameritrade Holding Corp. Also slashed trading fees to 0 on Tuesday. So Malcolm, I have a question for you, and I also kind of want you to summarize what's actually happened here. What does it mean that these brokerages or online brokerages have slashed and eliminated fees associated with trading stocks and exchange-traded funds?
In a word, it means they're coming for the folks in my industry who are retired on the job, so to speak.
Oh,
that's the big thing that jumped out at me.
Okay, what does that mean?
So I'll answer your question a little bit easier the way I know you meant it to be. But first, I just want to take a shot because I can. They really are coming after the folks that work at the 4 major brokerage firms I mentioned to you. I actually used to work for 2 of them, so I know personally that there's a good number of folks who are still cashing a check and clocking in every day.
Whose names you know.
Whose names will be, will be held away to protect the innocent.
Right.
But there's a good number of folks who, clients are paying commissions and trading fees.
Right.
But they're not really doing very much on the other side of it, right? So there's the whole group of folks that are actually managing client assets and on their behalf giving good advice and doing some due diligence on the client. And then there's also folks that are just waiting when the client calls and asks for something and they charge them a fee just to do it.
Right.
Those folks who are in the latter group are who this directly targets.
Right.
So if you're not still doing something and showing clients on an annual basis what you're providing them as a service to warrant the fee you're charging them,
Right.
you're at risk of losing those clients.
Right, because you're not actually delivering any value.
Yeah, you're not giving me anything for the commissions or the fees that you're billing me for,
Right.
other than access to be able to trade in the markets,
Right.
which now I can do myself
Right.
for free.
Right.
So if I'm a person who's even remotely technologically inclined and comfortable using online trading platforms, I don't really need to call that guy in the three-piece suit in the corner office with his feet on the desk smoking a cigar like they show you in the cartoons.
Is that what you do at work?
Not I. I don't own a three-piece suit. But that is, the image that
Right.
people have of that traditional broker, like
Right.
in the Schwab commercials where they say, like, as Susie Orman likes to say, the broker that only makes you broker.
Right.
So this, to me, is a shot directly at that group long term.
Right.
But getting more to the point that you were making, this basically means that individual investors like you and I, if we want to go online and open, I know you own a personal trading account online, this now means that anytime you decide I'm going to sell, a few shares of Apple and buy a few shares of Amazon, you don't have to worry about the $5 commission to place the trade, and then $5 commission to sell that same stock and then buy the next one and the next one, because those things add up.
Eating into the profit of what you made on the difference between when you bought and sold.
Right. The danger for people you're talking about, like Ameritrade, E-Trade, who stands to lose $300 million, is that the $300 million they're calculating is just the people who trade at their regular intervals now.
Right.
Now that it's free,
Oh, man.
I'm a little more inclined to trade one share at a time, whereas I would have waited until I had 100 or so
Right.
for it to be worth that $5 they're going to charge me.
Right.
That is the reason Fidelity is the lone holdout that
Right.
said, we think commissions aren't such a bad thing. We're going to keep charging them. Come at me.
Right, and just to kind of go back in the history of it, these online trading fees happened when the internet kind of came into view and kind of stepped in between.
E-Trade pioneered this market.
Absolutely, E-Trade was a pioneer in the space, giving individual investors or regular folks the opportunity to trade in the stock market without needing to call Joe with a cigar in his mouth.
Right.
And so essentially it's democratized in a lot of ways across the industry, the ability to go sell, buy, and trade stocks.
Such a millennial way to do things.
Indeed. And I think, these kinds of companies were feeling pressure from like the Robin Hoods, for example, which is a platform that allows you to trade for free. Now, there were other fees associated with it.
Sure.
And they also might be selling the data on the back end. But
Might be. All right.
But we're at a place now where anyone can kind of go online who has the interest and go and trade stocks with no barrier in terms of cost.
Now, you know the question I'm going to ask.
Which is what?
Is that a good thing?
I don't know, and that's where we were heading. What do you think?
We'll see.
We'll see.
I think it's important for the small dollar investor to have just as much access as the large dollar investor.
Right.
However, I think that it's also more dangerous for the small dollar investor to have no guardrails
Right.
than it is for the person that if they lose $1 million, it's, like sneezing.
Right.
Versus the person that if they lose $1,000 in the market, it actually is going to disrupt some things at home.
That's a big deal. And the fee, in a lot of ways, I know for me personally, it operates as a guardrail of sorts. Like, is this what I really, even the $5, because I think that the number range was like 5 to 7.
I think it was like $19.99 when I got my first E-Trade account.
That's
the fee
super
was like
high.
$19.99
Per
to
trade.
trade.
Wow.
In and out of that. So $40
That's
to
a lot.
buy and then sell. It'll change your mind if
Right.
all you're placing is like a $500 trade.
Right.
Now that it's free, I might do that 4 times through the course of the day and not
Right.
care because, it's E-Trade's money, it's not mine. Because it does actually still cost money to get access to the exchanges to place that trade and have somebody actually like execute your order. There is actually a legitimate cost associated with it. It may not be $5, but there is some cost built in.
Right.
So that's something they're going to have to figure out too. Like, how much of that cost are we willing to eat
Right.
just to have people stay on our platform?
Absolutely, absolutely. And before we go to our first music break, given the advancement of technology in the financial services space, how do you see the financial services landscape making way for more people and kind of, like I said, democratizing? What shifts are you seeing happening in the space?
The most interesting thing that I'm seeing is so many more fintech companies popping up left and right that do sort of like adjacent to, they serve sort of adjacent purposes.
Okay.
So they don't necessarily manage assets, but they might help you determine the risk inherent in somebody's portfolio. And just that one little thing, they're willing to charge, I don't know, $10 a month to a firm like mine. We might pay that if it's good enough, because it keeps us from having to do the 3-4 hours of like manual labor associated with it to determine the risk in that portfolio. I'm seeing a lot more of those like software as a service kind of companies pop up that email me like once a week, like, hey, check out our software, take us for a test drive. And it's like, you know, where were you 2 years ago? And then I go to their LinkedIn page and like they used to work for the Department of Treasury or something, and, you know.
Very good, very good. As we go to this first music break, I want to remind people you can always catch past episodes of the show on Apple Podcasts, SoundCloud, Stitcher, Google Play, and of course Spotify. Please leave us a review on any of those platforms. That helps more people catch our show. If you have a question for us or a topic you want us to cover, send us your suggestion, info@manageyourdamnmoney.com. And of course, you can catch us on social media, on Instagram and Twitter. My handle's @MYDM1. Malcolm, what's yours?
@MalcolmOnMoney.
And of course, you can always catch us on Facebook, facebook.com/manageyourdamnmoney. This is MYDM with Ben and Malcolm. We will be right back. Welcome back to Manage Your Damn Money with Ben and Malcolm. Where on this episode, the conversation at hand is the WeWork IPO drama and the mythology of unicorn startups. Malcolm, oftentimes many of the shows we write and the topics we cover are simply extensions of our text thread. An ongoing conversation that we've been having is my own tracking and possible delightment in the troubles of the well-known We Company,
better
known by its old name, WeWork. For the last 3 months, I would send unsolicited texts with articles about questions around the company's business model. All of this because of my own sneaky suspicion that startup companies like WeWork aren't necessarily built on solid ground. In this episode of MYDM, we are taking a look at the WeWork IPO debacle and what it says about the mythology of 21st century unicorn startups. Malcolm, so how long has this conversation been going back, like as you recall?
6 months maybe.
That long?
Yeah.
Wow, I was on it then.
You've been hating on them for a while. and I'll be honest, at first it just seemed like straight up hate. And then the more things started to unravel, the more right you started to seem, regardless of what your motives were for having, let's call it, suspicions. And then all of a sudden I found myself having to go, Ben was right. And you know how much that burned me up inside. Like, we had a conversation where the only response I could give was, you were right. And that just burned me up inside.
Ladies and gentlemen, this is a special day. Malcolm has given credit where credit was due, especially to me. Ladies and gentlemen, what is today's date? October 8th.
You better mark it down because it's going to be a solar eclipse.
Indeed. Well, you might be asking what we're talking about in terms of the WeWork. So I think it'd be best just to kind of start off with an article about it. How WeWork spiraled from a $47 billion valuation to talk of bankruptcy in just 6 weeks. This was a September 2019 piece on Business Insider by Dakin Campbell. Just 6 weeks ago, the co-working giant WeWork was the U.S.'s most valuable tech startup. Then it filed its S-1 registration for an initial public offering, disclosing a bevy of conflicts of interest and mismanagement by its magnetic and eccentric co-founder Adam Neumann. Investors, reporters, and analysts chastened after seeing the S-1 revealed a massive fraud, and watching Uber fail to live up to the hype. It didn't let other visionary founders pull the wool over their eyes.
Can I stop you for 2 seconds?
Absolutely.
The Form S-1 that you just mentioned is important because it's the public filing that goes to the SEC and to shareholders to let them know the pertinent details of the company that's like about to make this report.
And be available and publicly traded.
And be available to all of the public to see.
Right.
That is the dreaded form that has kept all of these companies you're about to discuss from wanting to go public in the first place.
Right.
Because normally a company like Uber or Lyft or somebody like that, they would basically run for about 5 or 6 years before they would get to a point where their investors are saying, cash me out, take this thing public, liquidity event today, and let's do this. And they went, I think, 11 years, they being Uber, before they actually did IPO.
And we're seeing that runway extend out with a lot of these tech companies.
Further and further, but I think we're going to see it come right back now that this has been brought to a head. So anyway, I just wanted to make sure that was clear, because like if I'm listening in my car or as I'm making dinner or whatever, wherever people listen to us, like, I'm like, S1, what is S1?
Right.
Absolutely. Car? So.
Absolutely. And then Neumann, the story went on to say, Neumann's IPO dreams crashed and burned, and now he's been ousted as CEO, and observers are wondering whether WeWork can avoid bankruptcy. Based on reporting from Business Insider and other news outlets, this story of the 6 weeks that almost ended WeWork. So similar to Lyft and Uber, WeWork's business model, it wasn't clear, at least earlier to me, whether or not it would bear out. And essentially what WeWork does is they go and lease out office space. They renovate it and create it into the really trendy spaces that we're familiar with as office space. And then they lease it out on flexible terms to small business owners and other people who want a traditional office space, or at least a space that they can call their own for their work. The issue is the leases they have on those spaces with the landowner that actually owns the building is a normal, 12, 24, 36 month lease. And so if I, as a small business owner, come on and say I'm gonna do 3 months, and I decide, at the end of that 3 months, I don't wanna be there anymore, that's then another seat they have to fill to actually account for the rent that they owe their landlord. They did that at a massive scale.
A little bit worse than that in the sense that their average lease is about 12 years.
Wow.
Yeah. So that's part of the reason they're talking about bankruptcy.
Right.
Their average commercial lease is 12 years in this thing versus a month-to-month subscription where I can sign up, take advantage of the space for a month, realize that I have no business being a business owner, go back to a day job, and WeWork is left holding the bag for my real estate, whereas before the thing keeping people from going and starting their own businesses was the cost of the brick and mortar. Now you don't have to worry about that. WeWork's going to take care of it. So, or they used to. So that's the rub.
And that's up against a backdrop wherein there are questions about these tech companies or tech adjacent companies, whatever you want to call them.
Yeah, because they're a real estate company.
And their ability to actually turn a profit eventually. So they're hyper powered by these investments and these investors. They're able to grow at massive scale. They're able to create a footprint like WeWork did. But the actual fundamentals of them getting people in the door and committing to long-term leases isn't necessarily on the up and up. And that's what some of the S1 apparently disclosed when it comes to WeWork in particular. Another article we pulled for this piece, The title reads, "A New York real estate group sounded the alarm on WeWork years before it plunged into chaos." This was an October 2019 piece, also on Business Insider by Theron Mohammed. An 85-year-old New York real estate group repeatedly sounded the alarm on WeWork years before the shared workspace company plunged into chaos last month, scrapping its initial public offering plans at the last minute and replacing the co-founder and CEO Adam Neumann. Executives at Empire State Realty Trust, which traces its roots back to 1934, warned WeWork's business model makes it a risky, undesirable middleman. They also complained its tenants put a strain on buildings and damaged them. And someone quoted in the piece says, "I think it's a bright, shiny penny in the fact that if I thought it was a good business, which we would engage, we'd lease to them. I don't." He went on to say their business models are weak. WeWork signs multi-year leases for office spaces, splits them out into smaller units and renovates them, then rents them out on a short-term flexible basis. And the company we mentioned has been reluctant to allow these kinds of companies to insert themselves between it and its tenants, Malcolm.
So here's what's interesting about that. You would call that a scam by any other means. If I came to you as a commercial landlord and said, I want to lease 10 floors for my business, and I had one business as an LLC on the name when I signed that lease with you, and you were like, oh my God, I got a tenant long-term for 10 years.
Right.
This is going to be great.
Right.
And then you showed up to visit me a month later, and there's a bunch of kids on skateboards, people sitting in beanbag chairs. The company didn't even have a logo or a name on it. It just, you were like, what is this? What have they done to my building?
Right.
It's kind of like they pulled a bait and switch, except for the fact that at some point, right, not necessarily in the very early days, but at some point, people knew what they were getting with WeWork signing up as a tenant. Right. So it's not as if you signed up with them in the last 4 or 5 years, you could be like, well, we didn't know they were going to do this. Right. Yeah, you did.
You knew why they were there, and who they were. An actual salient point in this whole thing is that at one point, WeWork was on the hook for $47 billion in future lease payments to building owners while having committed revenue of only, meaning commitments from people to lease from WeWork, of only $4 billion. $47 billion in future lease payments, only $4 billion in commitments. And last year's losses jumped to $1.9 billion on revenue of $1.8 billion. For every dollar it made, Malcolm, it was spending too. So my question is this, really, and in the frame of the conversation that we're having today, is what is to be said about these business models that try to provide affordability, flexibility for the end user, but is kind of hiding and obscuring the true cost of the business behind it?
Well, I think it's the problem is further than what you just outlined. Folks hiding just their ineptness or shady accounting practices, whatever it actually comes out to. I think the bigger problem is the fact that there's so much large-scale influence from such few people as venture capital firms that they're forcing these companies to do things that maybe they wouldn't normally have done had they not had that pressure behind them and kept their companies the way they were. Like, for example, I was listening to an episode of an NPR podcast that had Tristan Walker on there, the founder of Bevel. And the big thing that stuck out to me that he said was, if I had it to do it all over again, I never would have taken a single dollar of venture capital money.
Wow.
He started his firm inside of Andreessen Horowitz, a large venture capital firm.
Wow.
And like one of the founders is his mentor.
Wow.
And so for him to make a statement like that after selling his company for less than what he actually took in as venture capital funds, like that tells you there's something askew in that model. And the real problem is these guys have like so much money that has to go somewhere that they're willing to just give it blindly to anybody with any semblance of an idea to fund it. And then it's like rules be damned. Like throw caution to the wind, move fast and break things, that whole methodology. And that's to me what the real fundamental problem is, and the reason that, as we're starting to see, Wall Street is already turning its back on Silicon Valley, which is what had been driving this entire thing, was that Wall Street and Silicon Valley were in agreement, were in cahoots. Now it doesn't look like it's so much.
And essentially we've talked about the relationship between, I guess, Wall Street, which is a consumer like myself can go on and buy a share of a now publicly traded company. against the background of investors who are investing billions of dollars to grow this company. It used to be, yeah, we'll all get in this together and, you know, we'll pass these shares on to the normal folks out there in the consumer market.
Yeah.
But now it's like the consumer market is like, I don't want it. I saw something today about another company. I texted you the story. It's not in the script, but about some company that is tech adjacent. I think it's what is it? It's one of the food delivery companies.
Yeah,
and they're withholding
Grubhub, Postmates.
and they're withholding or thinking about.
They scrapped it.
They're scrapping their IPO as a result of what's going on. In a stat in that story, it was talking about how 2 years ago there was like a 94% increase in value for stocks of, you know, these tech companies that were newly publicly traded, but now the amount of the 19 that have gone on IPO in 2019 is like 5%.
Yeah.
And so it's been trending down in terms of the returns these companies are actually bringing, you know, Wall Street investors.
So we'll get into it on the other side of it when we start talking a little more about the broader problem in the other companies outside of WeWork.
Indeed.
But to bring it back to them for a second, something that really stuck out to me when I was like reading for the show is the fact that the thing that they were using to get to that $48 billion valuation that they gave to their investors, and they were taking the Wall Street to value their shares, was the fact that they had already themselves taken the venture capital money that had come in as an investment in WeWork and used it to invest in other companies out there in the market, other startups
which they were
out there in the market,
counting as valuations.
And they were counting that as a valuation inside of their own company. So if your valuation is inflated and I've invested in you, my valuation is now inflated. And they had like 40 of those inside of their portfolio. And that was part of what allowed them to prop up the value. That shady accounting is it sounds a lot similar to the kind of accounting that got Enron in trouble way back when.
I thought Bernie Madoff, but you know.
Not quite Bernie Madoff in the sense that people who were dealing with Adam Newman knew that he was a shark.
Right.
But definitely the Enron folks in the sense that like you didn't even bother to look that deep into the books because you wanted to believe the story.
And that's endemic of another problem, which we'll get into. But before we get into that, I want to remind you, you can always catch past episodes of Manage Your Damn Money as a podcast on Apple Podcasts, SoundCloud, Stitcher, Google Play, and Spotify. And of course, please leave us a review on any of those platforms. That helps more people catch the show. If you have a question or a topic you want us to cover, send it to us, info@manageyourdamnmoney.com. And of course, you can always catch us on social media. My handle's @MYDM1. Malcolm, what's yours?
@Malcolm on Money.
And of course, you catch us on Facebook, facebook.com/manageyourdamnmoney. This is MYDM with Ben and Malcolm. We will be right back. Welcome back to Manage Your Damn Money with Ben and Malcolm, where today's conversation at hand is the WeWork IPO drama and the mythology of unicorn startups. We pulled another article for this particular piece. WeWork is a symptom of a disease that may not have a cure. This was an October 2019 piece on MarketWatch.com by Teresa Poletti. It reads, the spectacular blowup of the proposed public offering of WeWork's parent company, We Company, shows that public markets are savvier than private investors about buying into the hype of high-value, high-risk unicorn companies masquerading as tech companies. The public market's response to the most recent batch of these mega private valuation companies? A firm no thanks. The street has gotten sort of stale on the idea of hope, said Daniel Morgan, a senior portfolio manager, quoted in the story. I don't think the IPO window is shut, but there has got to be more deals like Zoom and Pinterest where you have a light at the end of the tunnel. You have to have a business model that is profitable eventually. The seeming tide of never-ending losses at Uber Technologies, Lyft Inc., and Peloton Interactive. I saw a Peloton truck on the way in here today for today's show.
Do you know anybody personally who owns a Peloton?
Ironically, I do.
Okay.
And they're a real estate agent, so he's just like, all right, yeah, whatever. So he has one at his home, but only one person.
I know who you're talking about.
Exactly.
Everybody's got that bougie friend, I guess.
Indeed. Companies like this become a problem for investors, along with corporate governance issues at companies like We and Peloton. The biggest losers in the IPO market in recent months, beyond the We Company, are companies that claim to be tech companies, but are really using technology to enhance a product, such as a car service from Uber or Lyft, and Peloton's exercise bike, and Fiverr International, freelance job-seeking hub that has trademarked the word gig. Investors have been clear about how they feel about tech-like companies with no profits. Lyft, which went public in March, has seen its shares tumble nearly 50% and is now trading at a market cap of $12 billion, compared with the last valuation as a private company of about $15 billion. And since going public in May, Uber shares are down 30% and has a market cap of $51.8 billion compared with its last private company valuation of $76 billion. Peloton, a similar situation. They started here and now they're there.
Yeah.
As of October, a couple of details for WeWork specifically. As of October 2016, the company had raised $1.7 billion in private capital. Another piece, Mayoshi Son and Adam Newman had met for less than 30 minutes back in 2016 before Son decided to invest in WeWork.
He's another part of the problem.
Who is Son?
I believe it's pronounced Son.
Son, all right, well, he's Softbank's CEO, I believe, or the head of Softbank.
Right.
And Softbank is by far the largest shareholder of the office space rental company with a total that tops $10 billion. That includes a $2 billion investment in WeWork's latest private funding round at a $47 billion valuation earlier this year. Newman was once quoted as saying, "We do not lose money, we invest money in the future." And that was for Business Insider in May.
I think it was Jeff Bezos who coined that phrase.
Indeed.
Only worked out well for one of them.
Right. So let's break this apart. Like, there's all this money being pumped into these companies like Uber. And we're picking on these because they're the big companies people know. But
take a step back for a second. You mentioned somebody significantly important.
Right.
Masayoshi Son.
Yes.
Who is also, as you mentioned, the CEO of the investment company Softbank,
yes,
which is one of the largest investment firms, private investment firms in the world.
Yes.
So they've brought money now from China into the US market to invest in these startups where you and I might actually care if the company is profitable today or tomorrow or in the next 5 years. He doesn't.
Right.
So to put it in perspective, he also bought Sprint.
Right. Wow.
And it's still trying to figure out what to do with that.
Right.
So he's hoping to God that this T-Mobile merger goes through and he can actually save face and look like a guy that knows what he's doing.
Right.
But those are the kind of investments that people have criticized him for in the past for not doing enough due diligence.
Right.
But for him, he can afford to be wrong because the downside compared to the upside doesn't really matter.
Right.
And that has a undue influence on the way that a lot of these folks, these CEOs, are forced to now govern the company to appease people like that who have brought $10 billion to the table and call a lot of the shots.
Right, absolutely. So it's interesting to me because this is from another piece that I pulled, but it said that the two, Adam Neumann, who was the CEO of WeWork, and also Son, am I saying it correctly? Son, met for less than 30 minutes apparently before he decided to invest. And obviously those investment dollars are going to be huge. To me, that's a huge component of this whole equation where these companies are able to grow to this level. After just having met a guy who you see as visionary after 30 minutes. How does that strike you, Malcolm?
So Adam Neumann must be a hell of a salesman, right? Like, we can't discount that.
Right.
He did have to convince this guy to come up off $2 billion in 30 minutes. Like, that's no easy feat.
Sure thing.
But separately from that, I think it's also a testament to the fact that, like, Silicon Valley, part of the reason it's been criticized for the way that the funding dollars go around or don't go around really, is that folks want to all pile in on the same one idea. So it used to be that you had this guy, Mark Zuckerberg, who was traipsing around in a hoodie and a backpack and people thought he was crazy. But then when you really heard his idea for Facebook, you were like, all right, I'll take some of that. And the first 100 or so people that saw the vision reaped a lot of the rewards. Now it's gotten to a point where everybody wants to be the person to say, I was an early investor in X. And so they're all just piling on the same 100 same ideas instead of actually sprinkling that money around the Silicon Valley ecosystem, or even leaving that one small place in California and moving up and down the coast, or even over to New York and Chicago and Detroit and wherever else. Like, they're skipping over all these other places and focusing all their energy right there, where if you were to actually take those dollars that exist in Silicon Valley for private equity firms and spread them across all of the different folks out there that are working on startups, that next $100,000 could really get them there to bringing that idea to fruition, we'd probably have a lot more services that we actually want and need. Like, everybody doesn't need WeWork, right? But there's probably something out there that's not getting funded right now that we actually could benefit from, or it could legitimately change the way we operate the same way Uber did. We won't know about it because everybody keeps going into those same narrow lanes. And
you just kind of highlight exactly where I was going next. Is there, and I think there was a line that I forgot to pull, but it feels like a lot of the startup culture, especially now, especially in the tech space, is driven by this like bro culture.
Absolutely.
Is that a component? How much of a component is it?
I think it's 98.98%. Tech bro is the problem, and then everything else is people just haven't shown up yet. Because I really just got to it, right? It's the fact that everybody wants to invest in the guy who's the next Mark Zuckerberg. Which means that I'm looking for the 24-year-old Harvard dropout who's a white guy born to upper middle class parents who was already going to be okay regardless of whether or not I came along and gave him this funding. But I feel comfortable doing that because I know his story. His story is also my story. So I feel comfortable with his story. And everybody's looking for that same one guy and not actually paying attention to all of the other opportunities that exist out there. So yeah, the tech bro culture is definitely a significant part of the problem.
So just to kind of take it off a little bit, a lot of these IPOs kind of go through banks to actually get their stuff listed and go through a more formal process where a lot of money changes hands. There's other companies who you're familiar with, Slack, actually did it a little bit differently, where they did what's called a direct listing. This is a different approach to listing shares on the public stock exchange. Can you talk a little bit about that and what's different about that and why that's kind of coming to the forefront a bit, at least in some cases with these tech companies?
Well, so part of it is, and let me preface this by saying anybody who really wants to take a deep dive in this should go back about 8 to 10 episodes and listen to the one we did on IPOs. That was a great episode too. But to sum it up, essentially a lot of companies are looking at the fact that folks like Uber, for example, have spent $200 million in fees to get their stock listed, and they've paid those fees out to the likes of Goldman Sachs and Merrill Lynch and Morgan Stanley, the largest investment banks that bring the company to the public. Well, after paying that $200 million, the stock still fell on its face. Like Peloton you mentioned
right.
is a recent example. So if I was gonna pay all those fees, I'd expect that my stock would be up about 15% by this time, 3 months after I took it public, not down 15% after I paid you a fee.
Right.
The whole fee was for you to make sure that
it was popping.
Right, exactly. So I think people are looking at that and saying, if we're gonna bite the dust anyway,
right.
we might as well save some money along the way,
right.
and not give it away to the investment banks to not really do the service that we're paying them for anyway.
Right.
That to me is kind of transformational, because Slack has had success with it. Even though the stock price is down from when they initially listed it, they didn't pay out that $200 million or whatever in commissions to an investment bank. Spotify is another one that
right.
took themselves public.
Right.
They've proven that it can be done, and can be done with some success. And so I think that's the more disruptive thing that people should be paying attention to in the IPO world.
Right, for sure. Well, before we close this show, last question. When these hot companies, and WeWork was definitely is or was, however you want to say it, a hot company, how should normal folks scrutinize the possibility of what I have in quotes as getting in on the ground floor
right.
as a normal retail stock investor?
Well, I think for me, the easiest way to look at it and determine if I personally was going to invest in the company is if they're in denial about who they are. And what I mean by that is Uber, for example, Uber Technologies,
right.
considers itself a tech company and not a transportation company. That's a fundamental flaw to me in the way they think about who they are versus what they actually are.
You just put me on the couch with that one. Wait a minute.
WeWork calls themselves a technology company.
Indeed.
No, you're a landlord. Like, it's not sexy to say
right.
we're the biggest landlord in America,
right.
and so they want to say, no, we're a technology company,
right.
and it sounds great,
all
right? It gets you pats on the
things.
back at all the Silicon Valley tech conferences and whatever else.
Right.
But realistically, you're in denial about who and what you are. So to me, like when I look at Spotify, for example, in their S1, we are a music streaming platform.
Period.
We want to revolutionize the way people consume music. Sold. Sign me up, right? Like it's simple and clear what they do from day one. To me, that's the very easiest, biggest way to know whether I want them or not.
That was simple, and yet that was quite profound.
Well, I do what I can.
Indeed, indeed. Well, before we close this show, I want to remind you, you can always catch past episodes of Manage Your Damn Money as a podcast on Apple Podcasts, SoundCloud, Stitcher, Google Play, and Spotify. And of course, please leave us a rating and a review on any of those platforms. That helps more people catch our show. If you have a question you want us to answer or a topic you want us to cover, send it to us, info@manageyourdamnmoney.com. And of course, you can always catch us on Instagram or Twitter. My handle's @MYDM1. Malcolm, what's yours?
@Malcolm on Money.
You can catch us on good old Mark Zuckerberg, unicorn, startup man himself. Facebook.com/Manage Your Damn Money. What'd you say?
Until he bans us.
Indeed, indeed. We're talking so much trash. And of course, once again, thanks to our partners here at Montgomery Community Media for yet another amazing show. Until next time, be good with your money.
Peace.
Peace.